boss back. Get to work.
Hey everybody, Tomas Patterson here with Boss Financial. Welcome back to another video. Thanks for stopping by. Today we're going to be talking about something pretty interesting. Something that might have been a gray area for some of you, or maybe you actually never even thought about it and realized that there are actually two different options when dealing with securities and equities. Today we'll be going over the differences between being a trader and an investor. These really are two different strategies as well as mindsets, okay? So we're going to go over what both of these entail, as well as we're going to cover some misconceptions that you might have been previously exposed to. If you're going to be investing in the markets, growing your wealth, it's important that you pick a strategy, okay? And you're going to figure out how you're going to invest and stick to that strategy. That way you don't sway from the path and end up reducing your returns. There's a big difference between this guy, or you might actually recognize him as this guy, okay? That's Jordan Belfort, Wolf of Wall Street. And this guy, that's Warren Buffett, and we're going to talk about him more later in this video. So yeah, let's get into it. If you like this video or if you learned something, just make sure to take the 0.5 seconds to just hit that like button, and subscribe if you're interested in watching more of my content, which will be regular videos weekly. I really appreciate it, and it will help me grow my channel, so thanks a lot. So as an investor, we're not really worried about all these numbers and analyses, okay? We're more what you call fundamental traders as opposed to technical traders. So me, I'm an investor. I'm interested more in financial statements and those sort of numbers because those have real value to me. We're not trying to hit it big, okay, and sell. I mean, don't get me wrong. If that happens, that's great. You just got to know when it's a smart time to pull out, take some profits. But after all, we're investing in companies, so it's the business itself we're interested in. So that means we're not exactly following all this other noise, okay? The market, the daily stock price, and trends and patterns, guys. It's not important if you're in it for the long haul. Trading works off timing the market, while investing works off creating wealth through compound interest and dividends from holding quality stocks or funds. Traders thrive off of getting high returns month after month and by setting goals. So as an investor, you could be happy with a return of say 10 to 15% annually, okay, per year. But a trader on the other end, they might hope to capitalize on the markets, perhaps getting like a 10% return a month. So there really is a lot of money to be made with trading, perhaps more than investing. It depends how you look at it, but this is assuming that you're always going to be getting these returns and timing the markets perfectly time after time again. This all comes back to the popular saying, time in the market beats timing the market. With a big potential upside for active trading, traders can also miss the right time to sell, okay, or buy, which could lead to a big loss. This is why, in my eyes, it's important, it's really beneficial to view the stocks as what they are, okay? They're pieces of business and nothing more. If you're a long-term investor, a value investor, we're trying to reduce our risk while still producing great returns over time by simply just knowing what you're investing in. If that's not making sense to you, then actually just think about it. Picture it like this. If a random person approached you on the street, okay, and they wanted you to buy into their business on the spot, even if they promised high returns, would you just fork up the cash? No. Chances are you'd probably say something along the lines of thanks but no thanks, or get out of my face, you scammer. It's just not a good financial decision to be gambling with your money if you're in the business to grow it. Okay, but how about if this person approaches you and vouches for some of your friends or colleagues, that also invested? Would you buy in then? No. Well, I mean, I'd hope not, okay? You don't have no idea who this guy is, what his business is, if it's even legit, and he wants you to fork up the cash. It's the same principle with investing. You're not in the market because it's cool or because everything's going to work out in the end, as long as you're investing. And if you are, then my advice is get out of the market right now because the odds are just not looking good for you, my friend. It's also not some sort of bandwagon, okay, where you just buy everything up that your friends have, everything that your colleagues in the coffee room are loading up on, and definitely not what people on the internet, okay, including YouTube, tell you to buy. Let me tell you, in future videos, I'm going to talk about my portfolio and strategies, maybe even go over some stocks, but I will tell you what it is I'm investing in, the risk I took while investing in it, and why I'm investing in it, okay? And I will certainly never tell you to buy it, or for that matter, I'll never tell you what to invest your money on. I'm just going to give you information that you could use for yourself. As for now, I'm not an advisor, I'm just an educator trying to help viewers like you out there on your personal financial journey. Anyways, coming back to why you are in the market, okay? You're in the market to grow your money and increase your wealth. So why on earth would you put money into something, okay? You're buying shares or equity, stuff like that, without knowing what you're investing in. This is why research is important, okay? Now that word research, it scares a lot of people, but research is what's going to be the difference. It's going to help you stand out from being a failing, a mediocre or an average investor into a great or even a phenomenal one. Real world example. Warren Buffett is one, if not the biggest advocate for this principle, as he shared his knowledge and advice with the investing community for decades now. Who is Warren Buffett? He's an avid investor and a speaker who's currently the CEO of Berkshire Hathaway, which is a holding company currently in the list of top 10 largest companies in the world. Buffett is 88 years old now, and he certainly doesn't know his way around all today's technology and devices. In fact, to this day, he doesn't even own one computer. He instead chooses to read through piles of articles and reports, okay? So obviously you could still be a successful investor with all the tools we have at our disposal to help benefit us while investing. But as in Warren's case, if you know what you're doing, it's not needed at all. In fact, it couldn't be further from the truth, as Warren Buffett's net worth, okay, it's just over $88 billion. And that's in US dollars, okay, which means he's worth over $118 billion Canadian. He's currently sitting in number 3 for the world's richest people. He's just below Jeff Bezos as well as Bill Gates. Mind you, he's not far behind. He has simply adopted this principle that if he doesn't know enough about the company and how it works, who it markets to, the industry and said business it operates in, etc., he does not invest in it. He's been famous for being against investing in tech stocks simply because he does not understand the technology, business, or the market they operate in. This was a cause for a huge shock in 2016 when Buffett started purchasing shares of Apple, okay? We all know Apple. As of today, he owns about 5% in Apple. That's an enormous amount of money we're talking about there. Apple currently being worth just under $1 trillion. That means that Warren Buffett has about just a little $50 billion stake in Apple. However, despite this very handsome investment, this purchase had absolutely nothing to do with Apple's classification in the tech industry, but rather the fact that Warren sees great cash flow and earnings with a well-positioned value proposition and a high likelihood for Apple to stick around for a long time. Warren Buffett is a well-known fan of economic moats, okay, which is the individual defense a company has against competitors in the market. What makes you stand out or keeps your customers from going to other competitors, that's by definition your economic moat. It's your competitive advantage as a company. We all know Apple and the industry it operates in. These days you're looking at it's either Android or Apple, and Apple being a premium product in the eyes of its consumers as well as a status symbol in a way, okay, that's definitely their competitive advantage or their moat. So you can see the general theme here of making sound investments, investments that you'll be able to sleep at night if the price were to drop, or if your dividends example were to be randomly cut for a temporary period of time. You're asking why? Because it's as simple as this, guys. If you own a good business, okay, and you view this stake in a business as valuable, then you have no intentions of selling it. When I say long term, okay, I'm thinking of holding stocks or positions in ETFs, mutual funds, you name it, for a period of like 20 years plus, guys. That's a long term. Things are bound to happen. News gets released daily. Prices go up, prices go down. The economy does too, and so do people's emotions. But one thing that's been proven to be true for over 100 years is that the market always increases in the long term. So as I've mentioned, the key here is to buy good businesses and reduce your risk, which improves your odds of multiplying your money and decreases the odds of you saying goodbye to your hard-earned dollars. Because there's no other way to put it. If you're not picking up good businesses, or if you're hopping on some bandwagon or the hottest new trend, and this is when we get into speculation. Speculation is a way different thing than investing, okay? We've seen a lot of speculation with things like weed stocks as legalization of marijuana took place here in Canada October last year, or with Tesla if you've been following that company. Now that's always a 50-50 split on that topic there. There's always different ways to look at it, but I would say that Tesla, there's still a lot of heavy speculation. With the possibility of great returns, often, but not always, okay, not always, comes with the risk of great losses. And this is where you'll tend to see a lot of volatility in the market, okay? Volatility is fluctuation of prices, a lot of chaos going on as people are trying to capitalize on the speculation. Now this can be your regular, your standard, buy low, sell high, or shorts, okay? Where you're essentially betting against a company or for the share price to decrease in the future. If you do this is called margin trading, and I'm not going to get into that here. And then you have things such as options and futures as well. So there's really no one set way to make money in the market. This is very different from solely trading. Trading capitalizes on marketing patterns and trends, and most of all, uncertainty in the market. Day traders make most of their money in a short time span during the day with, 1 or 2, maybe 3 trades, which they start planning at opening bell first thing in the morning at the computer. It's also possible to take longer positions outside of a period of a single trading day, okay? This is called swing trade and operates over the same principles. Most traders who start out end up losing a lot of money, okay? Or they might not even start start making money until like 6 months to a year in, and it's really common to hear about that. Don't get me wrong, okay? There are ways to analyze, and there are a select bunch out there that are very knowledgeable and make a lot of money with day trading and swing trading, but me personally, I'd be willing to call it glorified gambling. If it weren't for the challenging aspects to it, and the infatuation with a spectacular or even unworldly return, then I would assume there'd be far less day traders out there and more long-term investors. Trading is based off the psychology of the market, okay? While investing is about the business fundamentals, and it's based off the concrete philosophy that runs a company. Consider investing more of an art form. It tends to start slower at first, with lower returns typically in the short run, but if held for a longer period of time, this can really pay off. Ideally, you want to have a mix of technical as well as fundamental analysis, which it's going to come with time, okay? It's developed with experience, so that's why it's important to just start slow if you have to, but start right away. Ultimately, it doesn't really matter which strategy you prefer, okay? Everyone's different. It's as long as you're reaching your financial goals, then you can consider yourself successful. Now, it's important to keep in mind, you can't just go out and start day trading really unless you have a lot of money. There's a day trading regulation which states if you place 3 day trades in a 5-day week, you'll be considered a pattern day trader. This is where day trading turns into a career, okay? It can get really, really addicting. When you're considered a pattern day trader, you'll have to carry a minimum of $25,000 in your trading account, and you're most likely going to have a margin account. When you're dealing with this much money, things tend to get a little more serious. You're throwing around a lot more, you're making decisions that have a lot more value to you, and that can literally make you unable to relax. This is where I've heard about and read about so many people who just lost themselves to day trading. They find it hard to hold down a job because they're sitting there with their eyes just glued to the computer screen. It's very addictive, it's time consuming with bigger investment of your time that could be spent elsewhere. And the people who handle it well and don't lose their hat in the process, I actually have a really high level of respect for them. Day traders tend to lose so much money because they're using large amounts of leverage, okay? They're buying large amounts of shares, hoping to capitalize on even very small fluctuations of a market price. This can often be arbitrage in prices or even trading on earnings or news. It's important to stick to a strategy because usually the risk outweighs the reward, which can cause people to get sucked in, if they don't abide by their own rules. This is why, if anything, myself, personally, I prefer to do maybe 1 or 2 swing trades here or there if I try anything outside my long-term strategy. Traders use technology to scan, candlestick charts and graphs for patterns and indicators like, your RSI, your relative strength indicator, or your moving average, okay, all that jazz. But in the end, when it comes to personal preference, once again, I'm not knocking day trading. I only wish that I could be successful at it, okay? It's just that it's not something I like to mess around with. Like me, I'm not a guy that goes to the casino a lot. I'm not much of a gambler. I like to keep my money. Every dollar I have is hard earned, and I appreciate and I understand its value. It's my goal almost in life to preserve these dollars, okay, and make them grow for me. And I just simply don't feel comfortable putting them on the line and involving myself with the risk as well as the different lifestyle that day trading brings. I'm an investor. I love business and I enjoy buying ownership in great businesses that I want to last and be a part of into the future. It's more fulfilling for me, and I feel like it's better to play in the market than play against it. Well guys, that brings me to the end of the video today. It was nice, short and sweet. I hope I kind of stirred up some thoughts in your head, as well as maybe answered some questions you might have had, maybe clarified a few things or some assumptions you may have heard. So by the way, if you'd like to see a video on margin trading and different types of trading, comment below. I could always create a video specifically for that topic and go into more detail there. If you enjoyed this video, if you learned something, go ahead, do me a favor and hit that like button down there for me, guys. It means a lot. I'm taking this YouTube thing seriously, and you're going to be seeing a lot more from me. So if you want to be a part of this business community, the Boss Financial community, smash that subscribe button too. Hit the notifications if you want to know the second my videos are dropped. Follow Boss Financial channel on Instagram and Get Social. Any questions or comments, leave those below. I'll be sure to get to those. I read everything. So there you have it, guys, the difference between a trader and an investor. Once again, and as always, I thank you for watching, guys and gals. Stay positive and see you next time.